Good afternoon, everyone, and welcome to the Billing, Payment, and Credit Enhancements Issue Paper and Draft Final Proposal. My name is Elena Coppola-Alford, representing ISO Stakeholder Affairs here at the California ISO, and I'll be facilitating the call today. I'm joined by Dan Schonkweiler, Assistant General Counsel, Corporate and Litigation, Denise Walsh, Controller, and other members of the team. I have a couple housekeeping reminders before we get started. So as you noticed today, you had to pre-register to get into the meeting, and this will be our process going forward for all stakeholder meetings in the future. And you will just have to go to that same pre-registration link, which will be made available in the notice and on our public ISO calendar. WebEx earlier this year made an update where they disabled the ability for attendees to see each other, and so the pre-registration process is our way to provide that list to you so you can see who is on. So as a reminder, the call is being recorded for informational convenience purposes. Any related transcript should not be reprinted without the ISO's permission. And if you need technical assistance during the meeting, please send a chat to the event producer. Our event producer today is Michelle, or you can send it to myself if you have other questions, or to all panelists. For raising your hand, if you connected to audio through your computer or use the Call Me option, select the raise hand icon at the bottom of your screen. If you dialed into the meeting outside of the WebEx, you can press #2 to get into the question queue. And please remember to state your name and affiliation before making your comments. And you can send your questions to all panelists in the chat. I'm going to hand it over to Dan Schonkweiler.
Yeah, good afternoon, everyone. Thank you for tuning in for this important topic that's close to us. I'm an in-house attorney who supports the ISO when there's a market participant bankruptcy and other related litigation, and Denise Walsh, the controller, who's here with me, works with her team that supports the billing and payment process and the credit process. So we've seen a lot of issues related to this, and we've got some proposals for improvement that we think are worth your attention. How do I advance these slides?
Yeah, Dan, you can press the up or down arrow, or you can click on the deck itself and hit your space bar. That will advance the content.
Thank you. All right. So here's our agenda for this afternoon. We have an introduction, some background materials, and a little bit, and then here's the rest of the roadmap. These bullets on this page, section 2, section 3, etc., those correspond to the paper, the draft final proposal and issue paper, to help you line up what we're describing in each, as we go through this, to the paper and what's described there. And so there are some themes here, and one of the first set of proposals have to do with avoiding payment defaults. And we're going to talk in the introduction about what this means and the significance to the market. But first section, or what we'll call section 2, are trying to prevent that from happening. Section 3, the proposals there are, well, what happens if there is a payment default that has to be spread to the market? How can we reduce the workload and reduce the harm to the market? Section 4, there's an isolated proposal about new methods of payment, such as FedNow, and the possibility of being able to use that to pay the ISO market. Section 5, there are a few proposals for tariff cleanup generally in this area. And then section 6 isn't the only section that's the issue paper, but we want to get a discussion started about how the ISO can improve its visibility into the financial condition of load-serving utilities in the ISO balance and reporting area. We'll conclude with next steps. There are a number of proposals here, and they're different and they're somewhat complicated. So we're going to stop after each proposal or group of closely related proposals and ask for questions or comments then, so we can focus on each idea and dive into the complexities. I also we'll come back to this at the end with next steps, but as a reminder, the proposals in section 2 through 5 are draft final proposals. These are proposals that we anticipate taking to the board and the EIM governing body for approval in November. The remainder of the issue paper, we would resume on that topic in 2024. So overall, and by way of background, what the theme of all these proposals is to strengthen the overall market resilience and to reinforce the billing and payment process. Well, what are we talking about with the billing and payment process? At the most basic level, this is the fact that the ISO issues invoices for market activity every Wednesday. And invoices are when a market participant has an amount payable to the rest of the market. It corresponds, then there are payment advices, and a payment advice is when a market participant has a net amount due from the market. And those go out Wednesdays. They only go to certain types of participants. We'll come back to this, but scheduling coordinators, CRR entities, EIM scheduling coordinators receive invoices and payment advices, but not other types of market participants don't interact directly with the ISO over billing and settlement. They interact through one of those other entities. To tie this into one last detail you're familiar with, each invoice and payment advice covers a range of settlement statements that are specified on the payments calendar. Otherwise, we're not going to get into that, but just to connect up those issues. So the invoices and payment advices go out Wednesday. Payment is due on the invoices the following Tuesday. It seems to always come in, but Dennis Estrada and Shauna add up all the money and assuming everything's come in, they send out the funds that same day to all the recipients of the payment advices, and then the market then everything is cleared for that payment cycle. That's how it almost always works, but then our focus in this initiative is what happens on those rare occasions when a market participant doesn't pay its invoice or its full invoice. Now let's pause here for a moment, because even a non-payment by a market participant doesn't necessarily mean the market is going to lose out. In other words, there can be a payment default, and yet all the market creditors with payment advices can receive full payment. And the primary protection for the market and the way that would happen is posted collateral. There's a whole section 12 of the tariff is all about credit and rules, and you're all, I'm sure, familiar with that. Now, we'll flag this and we'll come back to it. Collateral may not always be available right away, though, especially if a market participant is filed for bankruptcy. So keep that in mind. In addition to collateral, or if there's not enough collateral available right away, there are a couple other strategies the ISO has, or tools we have to clear the market. One are the reserve accounts that can cover cash flow temporarily. Another one is using good collection strategy in connection with a bankruptcy. We'll get into some of that. A third one, and we're not going to come back to it, except that it's worth mentioning. The newest development in market participant bankruptcies is that market participants have recognized well, let's try it this way. The bankruptcies of our market participants recently have been due to reasons other than their performance in the ISO market. The ISO market is a moneymaker, or central to them making money on their business. And so the last few bankrupt market participants have sought special permission with a first day motion when they file their bankruptcy to continue all payments to the ISO market as usual. And so when that happens, and we hope that continues in any future bankruptcies, there's no effect on the market. Market's always paid in full, and that's worth mentioning. So what happens, what are the rules if there aren't somehow, due to bankruptcy or insolvency and some other things going wrong, if there are not sufficient funds on a Tuesday to pay the market creditors? Here, I'm pointing on this slide to the general rules about default losses. There are two steps. One is that the market's cleared initially by reducing payments pro rata to the creditors. It's a little more complicated than that. Maybe the small creditors are paid in full, and then the pro rata is spread around the larger creditors. And then on a subsequent invoice within the next couple of weeks, that loss is reallocated to the broader market, not just those who were due money, but even those who paid in. It's shared more broadly, and there's a formula. And that, for those who may remember it or were involved, there was a complaint proceeding at FERC and a settlement. And as part of the settlement, this reallocation, or what you also might consider step 2, was adopted, and that was in 2011. If there's a loss that's allocated to the market, the ISO then pursues collection on behalf of the market. If we recover money, we distribute it. This originated in 2012 as part of FERC's Order 741, where they ordered ISOs and RTOs to become central counterparties. So you may remember events before then that were different. These are the rules now. Fortunately, none of this has happened in, where are we at? 22 years, more than 22 years. The last time the California ISO spread a default loss to the market was in 2001, at the tail end of the crisis. Now, payment defaults continue, and since the 2001 loss that was spread, I count more than 20 market participants, California ISO active scheduling coordinators, or CRR entities that have filed for bankruptcy or defaulted without filing for bankruptcy. And we've found ways, using some of the tools I mentioned earlier, to pay the market in full and on time through these 20 bankruptcies. Now, probably some good fortune there, and certainly past performance does not guarantee future results. And so we've looked at this. We were prompted, there have been several aspects to this. Review was prompted initially by events in external markets, especially in Texas, but also the UK, and us facing up to the question, what would happen if California had a sustained period of high energy prices? Would we be ready for that? And then during this review, we actually had a couple of payment events. We had in May of 2021, we had a market participant bankruptcy that we had to deal with. And then in November of 2022, we had a separate payment default without a bankruptcy. And each of those events led us to dig into this further. And what you're going to have here are the proposals that we think are targeted to make the improvements I've described, to reduce further the chances of defaults that could be spread to the market, and to also help the ISO mitigate the harm if that did happen again. Before we shift to those proposals, I want to remind people of some terminology, because I will use the terminology hopefully correctly, but it's just helpful to distinguish between a few things. People, in ordinary conversation, we can conflate bankruptcy and insolvency. The way I'm going to use insolvency, or try to, insolvency means a company's insolvent if it either can't or won't pay its bills right now. That's a financial term. Bankruptcy is a legal proceeding, and so the difference is a market participant in bankruptcy may not be insolvent. And I'm going to try not to mention market participants here, but the one you may remember, it was so public, was when PG&E filed for bankruptcy in 2019. They were very clear they were not insolvent. It could have gone on for a while. They were concerned about some legal proceedings and what might happen in the future. And insolvency is not a requirement to file for bankruptcy under the bankruptcy code. And also, an insolvent market participant may not file for bankruptcy. We had the November 2022 default was by a small market participant that just closed its doors, abandoned shop, and did nothing, which poses a different set of issues. But it's worth bankruptcy just generally, for at least from the standpoint of Denise and me and everybody at the ISO. It's generally, we see it as a market participant going through bankruptcy is finding a solution for a potential insolvency. It's getting themselves, almost always restructuring themselves so that they can pay in the future.
Yeah.
What's important about bankruptcy is the automatic stay. A market participant or any company that goes into bankruptcy or Chapter 11 freezes its past sort of bills and obligations in place. And so any creditor like the ISO could need court approval if we wanted to use what's called property of the bankruptcy estate. And the most significant example would be cash collateral. If a market participant had posted a large amount of cash collateral, enough to pay their bills, and then filed for Chapter 11, we probably would need court approval. It's always going to depend on the circumstances, but we'll probably need court approval to use that to pay its bills. And so a bankruptcy, even if it doesn't result in permanent losses to the market, could result in a delay of payment. Let me stop there. Do you have anything else to add?
No, that's right. That's right.
So let's dive into some of these proposals. All right, good point, Denise. Let me stop here. We're going to stop after each proposal, but are there any questions or comments on that background? Anything we ought to be, or ahead of all the rest of this? Is there anything that needs to be cleared up now?
I do not see any questions at the moment.
Thank you. Thanks for checking. All right, let's go ahead. We've got two proposals here about trying to avoid payment defaults. And the first one has to do with the minimum participation requirement. I've got a slide of background here about what that is. FERC Order 741, this is from about 13 years ago. I lose track of when the order was versus compliance. But it required ISOs and RTOs to all enforce a minimum capitalization requirement. And we are, again, talking about this is for participants that engage directly with the ISO in billing and settlement. It's not for everybody who puts power on the grid or takes it off, but for scheduling coordinators, CRR entities, EIM scheduling coordinators. And the general requirement is either total assets of $10 million or a tangible net worth of $1 million. This requirement is separate from and in addition to any rules from Section 12 about collateral. At the time, the CAISO and the other grid operators proposed exceptions for certain smaller market participants because there were companies that participated in our markets and we all wanted to participate in our markets that could not meet these general requirements. And the substitute or the alternative for a small participant was a cash posting of $500,000. Again, this was in addition to any collateral that might be required under Section 12 based on estimated aggregate liability to the market. It's just a separate additional posting to show seriousness and commitment. This proposal concerns a further exception to this general exception. So in addition to this allowing some small market participants to post $500,000, the tariff also allows small participants to decrease this minimum participation posting from $500,000 to $100,000 after, and the condition for doing that is having low participation levels over 6 months consistently. It's to have an estimated aggregate liability less than $100,000, I believe, that entire time. Our proposal, I'll be more specific about it on the next slide here, is to eliminate, our proposal to eliminate this second exception, and which would mean requiring any small market participant that can't meet the general 10 million, 1 million requirement would have to always post $500,000 in addition to its collateral. Now, I'm going to stop here. This presentation is going to have several proposals, and I wanted to help the slides be clear and help you all, or more clear, and follow along. Every time, every slide that explains what a proposal is, a separate proposal, I begin with the word proposal on top. There's a little bit of a flag here. If it doesn't begin with that, there's a proposal on a different slide, and that's either background or an additional reason for that proposal. I hope that helps follow along. So that's our proposal. We're going to eliminate we would eliminate the rule that authorizes a reduction of this cash posting to $100,000. There are a couple reasons for that. First was the November 2022 default. The way we put it, that small market participant found a way to essentially gamble with house money, and they were happy to walk away from their $100,000 and just shut their door. And that, the way we interpret that is the $100,000 posting is insufficient to deter walking away. That's not the behavior. We can't have that behavior. It can lead to defaults, and so that's one reason. I see this question. We'll stop at the end of the slide and go to discussion here. The second reason is when we researched it, it's complex, but we researched the other ISOs and RTOs, and as it relates to financial participants, meaning participants that hold CRRs or make virtual bids, they all require $500,000 minimum posting in this category for the smaller participants. So at this point, we're an outlier on the low end, which is a problem in and of itself, potentially. There was consideration of keeping this $100,000 exception for energy-only participants, but we did a look at who was posting $100,000, and it didn't seem to be necessary, and it didn't seem to be worth the extra complexity of the rule and the administration there. So those are the reasons for this proposal. So now is the time for comments or questions. I saw at least something float by on the chat. How do we handle this? Do you want to flag that person? Or, well, let me see if I can read the question.
Seth Cochran has a question. Seth, if you raise your hand, we can unmute so you can ask your question. Or you can type it in the, oh, there you go, okay. Okay, Seth, go ahead.
Thank you, Seth Youngji. I really appreciate the CAISO thoughtfully looking through their tariff. I think they highlighted something that needs to be updated for the reasons you had mentioned. I was curious, some of the other ISOs and RTOs out there are actually looking at raising the other attributes or elements of the minimum capitalization, specifically SPP moved up their asset test, I think, to 50 million and their tangible net worth to 10 million. Have you looked at any of those, or have you only looked at the alternative posting? I'm
going to refer that question to Denise. Have you looked at anything at this point?
I don't think that we have gone beyond what Dan has just described. Seth?
Well, I
Okay.
think that though, if you write about this in your comments and anything you can refer us to, or a link to an SPP document, we have essentially a phase 2 of this that'll begin in 2024, and so that would be we did add that to what may become a list of items to consider in the second part.
Sure, and any, I mean, even for this, the draft final proposal, you can certainly write in your comments and steer us to what it is that you see, and let us know if you have concerns over what we're kind of discussing at this point.
Okay, and just to be clear, I don't have any concerns with what you're proposing. I'm just wondering if the scope should be expanded to
Sure.
include. Yep. Okay. Thank you.
Yes, no problem.
Are there
There's currently no other questions in queue.
Okay. Let's move ahead. We have a second proposal in this category about avoiding or reducing defaults. The second proposal is about a legal designation, about adding something in the tariff to designate a single contract to govern all settlements and billing between a market participant and the ISO. So here's what we mean. We're focused on, again, the agreements that involve direct interaction with the ISO for billing and payment. Scheduling coordinator, EIM scheduling coordinator, CRR entity, and participating, or the transmission owner, or the under the agreement under the transmission control agreement. Some market participants, many, have more than one of these agreements. And if a market participant in that category were to file for bankruptcy, the multiple agreements is at least a potential source of litigation. You can imagine if a creative bankruptcy lawyer trying to say, hey, all the charges are under one agreement and all my credits are under another, and I'd like to give them different treatment, right? This happened. Something like this happened with the Morant bankruptcy 20 years ago. This is very public. But a bankruptcy team tried to collect on all the credits due to them and leave the rest of the market with bankruptcy claims for the amounts that were due to be paid to market. That didn't work, but we don't want to even become involved in anything like that again. So the proposed change here, it is a legal change only. It wouldn't require new agreements. It wouldn't, to our knowledge, any other practical change by market participants. It would be a tariff change that would designate that when a market participant has more than one of these agreements, it would designate one of them to govern all billing, payment, and settlement. So it's clear that there's one contract for everything. And I want to point out the idea that to avoid legal fights, it has a separate additional advantage, and this has to do with supporting ISO collection efforts. So let me describe what those are. It's about netting debits and credits. Among the market participants that have filed for bankruptcy over the years, most of them are not vary week to week in their position with respect to the market. Sometimes they're a creditor, sometimes they're a debtor. And it's common when you're in the market's position to say, so somebody may file for bankruptcy, owe a little bit to the market, and the next week, but it may still be a pre-petition week, they're due a payment from the market. And what we want to do is not pay them that money, but take it and use it to satisfy their debt so that the market is neutral. Attempts to do that, attempts to net like that, are governed by one of two legal doctrines. One is called set-off, the other is called recoupment. And which one applies is complicated, but the point is, for present purposes, if it can be recoupment, that's better for the market. It's better from the standpoint of collection because if netting qualifies as recoupment, the ISO would not need to go to the bankruptcy court to get advance approval. In other words, the netting can happen right away and the market can be paid right away, or the loss can be avoided. It also applies over a broader range of cases. It has to do with crossing the barrier, the pre-petition, post-petition barrier. But the gist of it here is the market wants the ISO to be able to recoup if possible. Now, the full extent of what's recoupment and what's not is complicated, but let's put it this way. The minimum requirement for recoupment is that all the debts and charges, all the debts and credits have to arise under the same contract. And so if we have a market participant that's got 2 or 3 contracts that could govern its financial arrangements, it may not be possible for the ISO to use recoupment, but if we can designate one single agreement as governing the entire financial arrangement, we have a good chance at having recoupment, which benefits the market. Here's the proposal. I copied this straight out of the paper. You can find it there too. But the idea is to add tariff rules that create priorities between the different types of agreements. So if an entity has a scheduling coordinator agreement and a CRR entity agreement on the first line, tariff would say all settlements would have enough rules there to specify that all settlements are governed by the scheduling coordinator agreement. All settlements, all billing and payment. I'm not going to read the rest of the chart, but you get the idea. Might need more than one of these rules if an entity's got 3 or 4 of them. But that's that's how it would work. I feel like I've seen a question come up in the chat. Let me leave that up. But let's turn to questions or comments. Are there any questions about this rule or how it would work or the benefits?
There are no questions in the audio queue. I see a couple of questions in chat, but nothing in the audio queue.
Yeah, I'm not. Go to chat again. Oh, here we go.
There was a question in the chat to us from Garnet Perlis, and I don't know if that's something that maybe Garnet wants to raise their hand and ask out loud. We were just answering it via chat.
All right, let's go back. The question I see.
Okay, so Garnet raised her hand. Should we go ahead and go to them?
Yeah, why don't we, this question refers to the previous proposal. Let's go back to it. Let's try to clear out this proposal, and then we'll go back to the previous proposal to try to keep the discussion on one topic at a time. Are there any comments about this present proposal? Scroll down. Okay. I don't see in the chat or otherwise any comments on the present proposal about designating one agreement to regulate or govern the financial arrangement.
I didn't see any in the chat either, Dan.
All right. So now let's go back. So let's go back to the previous proposal, which is about the minimum participation requirement. And the question is, if an entity has a collateral posting of greater than 25 million, is this a non-issue for the entity? Let me see, there may be more to the question. A letter of credit as a form of collateral.
So just bear in mind there are 2 pieces, right? What Dan is talking about is the minimum participation requirement, which that's something that has to be addressed as the market participant enters the market, and then a separate issue for collateral.
Right.
So, Garnet, is the question specific to the minimum participation requirement?
So Garnet can't, it says he can't unmute, so.
Okay.
Okay, let's see.
My take on this question, I mean, I see I think everybody can see the chat. So this question's coming from the Department of Water Resources. I'd be stunned if the Department of Water Resources doesn't have $10 million in total assets. You know, that's an astonishing amount of assets there. And so for most participants, and for not just DWR, but most participants, you're going to satisfy the minimum capitalization, the general minimum capitalization requirement of 10 million in total assets or 1 million in net tangible assets.
Tangible net worth.
Tangible net worth.
So it's not an issue,
This additional cash posting is only for small participants that do not meet that general requirement of 10 million total assets, 1 million tangible net assets. I'm hoping that answers the question, but by all means, add more to the chat if that doesn't.
Yeah, and Garnet, if you keep your hand raised, we can unmute you. Okay, Garnet, go ahead. Michelle's going to unmute now. Okay, go ahead.
The concern is on Section 2. Without California Water Resources doesn't have to worry about Section 2, right?
Well, so like I said, I am pretty sure you all satisfy the general capitalization requirement of $10 million in total assets, $1 million in tangible net assets, or tangible net worth. I'd be surprised if you don't. I'm not exactly familiar with that, but that'd be where I'd look. Our proposal is only about small participants that don't meet that general requirement.
Right. Yeah, that's why I just need to get verified that this Section 2 is specifically for smaller entities.
Yes. Well, yes, it's for smaller entities that do not meet that general requirement.
Thank you.
Sure. And let me add something. You can, of course, we recognize that all these proposals are complicated. And so don't hesitate. I'm going to put, it's in the last slide, or the second to last slide, I put my email address if you have questions about some of these legal concepts we're talking about or how any of this would work. You can also reach out through your customer rep if you want to know how these, or to the credit team, if you want to know how these proposals would apply to your organization. Those are other ways you've got, but we do want people, we realize this is an unusual proposal and we want people to be able to understand it so they can comment effectively.
Yes, and get your questions answered. Yes, definitely.
So don't hesitate to reach out. And again, it's my own email is going to be on the second to last slide. So that's Section 2. Let's move on. Section 3, there are more proposals here. They're a little less complex. But they're all about what happens if we're going to have a payment default, and how does the ISO manage it or avoid harming the market or reduce the harm of the market. The first couple of proposals are about the CAISO reserve account. And so this is a little bit of background about the reserve account or related account. It contains funds that are available to cover cash flow issues temporarily. So if there's not enough money in the clearing accounts on a Tuesday, money from the CAISO reserve account may be able to help clear the market without a loss, but it's only for the cash flow issue. The CAISO reserve account has to be replenished later. It does not, subject to one very small proposal we're going to make later, it's not there to pay for energy or market losses. It's there just to make sure that payments are timely. That CAISO reserve account currently holds about $1.8 billion. So it can cover decent sized losses, but there are certainly bills that exceed that amount. a lot of bills that we see. The ISO's practice since startup has been to use these funds to cover a default loss indefinitely, up until the time the ISO determines that it can't collect. And a good example, and this one's public because we filed a settlement with them and they're also gone now, was Lehman Brothers. In the 2008 crisis, I think we only had one bankruptcy filing, and that was Lehman. They were a market participant, and they owed a little bit of money to the market. What they owed was covered and paid to the market through the CAISO reserve account. We were also holding cash collateral for Lehman that was more than enough to pay those charges and some other charges. We ended up, not that long ago, sending the rest of the money back to the Lehman Brothers estate. So we knew the market was going to be paid. It was a question of how long until we resolved all the pending issues with Lehman and got at not much cost. We didn't want to pay a lot of money for this. Got bankruptcy court approval to actually apply the Lehman Brothers collateral and pay it off. And so that took a little bit of time. It definitely took more than a year, but that's a good example, and there was no effect on market payments. So that's a good example of how the CAISO reserve account's used. The penalty reserve account's similar, but not exactly the same. It's got a smaller amount of funds. This was created, I guess, 10 or 12 years ago when the ISO began a program of penalties that are, I think, around $1,000 usually for late, if payment comes in late on a Tuesday or if collateral is posted late. And that's, as I understand it, that program has been a strong incentive to make sure payments are on time. It's been very helpful. And so there aren't that many penalties in the account. There's not much money. But what's unique about it is, or what's different is there is no intent for, this is the original FERC filing and just sort of common sense, that the market would actually replenish this. These funds go permanently to cover market losses. And which makes sense, right? Because it's supposed to be a penalty on the on an entity that paid late and not a separate charge to the market. Those two funds are available. Our first proposal has to do with the CAISO reserve account, the larger of these. There was, in 2011, there was the tariff amendment about, oh, wait, we have a question here.
We have one hand raised from Seth, and then there is a question in the chat as well.
All right. Yeah, let me stop before the proposal. The chat question is, what determines the amount that goes into the CAISO reserve account? When does it have to be replenished if used? We're going to talk about replenishment. That's the proposal. What determines what goes in? My understanding is that what goes into the ISO reserve account is if there's been, in practice, if there's been market money that doesn't belong to anybody. And one example would be early on there were the FTRs, the predecessor to CRRs under the old market. Sometimes money would be with the ISO, a large amount of money overnight before the auction, and this was before the time that there were separate interest-bearing accounts, so the interest would go back to participants. And so a bunch of money that wasn't clear how much belonged to who would be in the account overnight. Interest would be earned, and that interest would then, the ISO would transfer that interest, or did transfer that interest, into the market reserve account, because it's not our money, it's not GMC, it doesn't belong to us, it sort of belongs to the market generally and should be used to benefit the market. And there have been a couple of instances like that over the years, and the money's been saved, but this isn't funded by any particular market participant or by GMC. It's just, it accumulates it's a place to put money if it's meant to benefit the market and doesn't clearly belong to anybody.
And Mark, we've seen some larger growth of late because interest rates have obviously increased. So that's the reason why it's at nearly 2 million.
And well, I should add, and it's a primary reason why there haven't been any, you haven't seen any defaults, either permanent or just delays in payment over the last 20 years, because there have been several occasions where that could have happened, and like the Lehman case, and the cash flow issue was covered by the market reserve and then it was replenished and the funds continue to grow. Okay, we got a thank you from Mark. Is there a question from Seth? Elena?
Yeah, event producer, can you please unmute Seth? Seth, go ahead.
Yes, Seth with BCMG. So just a kind of detailed question about the mechanics here. So when there is a no payment and it looks like it's not going to be collected, goes through the cure period, and you have to hit these reserve accounts, which one do you hit first? Do you shore up the missing funds with the general reserve account first, or do you use the penalty reserve account first?
Good question. There are no rules about that I'm aware of, but my general sense, having been involved in these situations, is there's always been an obvious answer. Sometimes, I mean, the balance of the penalty reserve account was something like $20,000 or $30,000 into last year when we used it for the first time. And so it wouldn't cover much of a default. And so most of the defaults would have exceeded that balance, and we would have had no choice but to use the CAISO reserve account to cover it. But otherwise, there's nothing in the tariff that specifies priority.
Okay, I'm not thinking there needs to be, but it was just a question that was lingering in my mind when I read the draft final proposal and went through the tariff. So thank you for clarifying.
Sure, good question, and I guess a way to summarize my answer is we've never had to confront that. Never had to solve that problem.
I think the main difference that we have to be aware of is that we must replenish the market reserve account, but there is no replenishment requirement for the penalty account. That's one of the main distinctions here.
Well, and in that event, you might as well hit the penalty one first, because if it
depends on how big.
In fact,
depends on how big. Yeah.
Fair point. Fair enough. But you would never have to go back and rerun the default collection for if it was covered by the penalty reserve account.
That's right.
That's right. Yep. Okay. All right. So now let's talk about replenishment. So for the CAISO reserve account, or what Denise just referred to as the market reserve account, the larger one, the rule and the practice have always been we don't need to replenish until the ISO determines that it can't collect or can't collect the full amount. In 2011, there was a tariff amendment that unintentionally got involved in this. It was the complaint and the settlement at FERC that had to do with making sure that any default losses are allocated to the entire market and not just creditors, not just those owed money. And if it helps imagine this, it's a little abstract. For those who aren't familiar with it, I think this is a fallout from the crisis. During the 2000-2001 crisis, all losses were allocated to creditors, meaning at that point, that's generators, right? Suppliers got the losses, and load wasn't allocated any of the losses. And that's my general understanding of that 2011 tariff amendment, with the sense that that's not right, and that the entire market ought to share it. Now, That was the sole purpose of that tariff amendment. Nobody was talking about replenishment in the reserve account, but there was some language inserted at that time that could be required or could be read to say, no, the ISO has to replenish the CAISO reserve account as soon as practicable or within weeks. And that wasn't consistent with what we were doing at the time or what we've done, but we want to clarify that language to conform with a long-standing practice. And the basic reason for this, I want to pause on something here. It's this last bullet. And I want to pause on it because it's the basis for a couple more proposals that are coming in this discussion. But it's our sense and our assumption that charging small defaults to the market unnecessarily imposes pretty significant costs. Let me just pick an example. Let's say there was a default of $10,000. When you spread that out to the whole market, the amounts are very small for each participant, but it would require a lot of manual work here to allocate that loss and then to do the work when it all gets paid back to everybody who shared it. And just as important or more important, we believe or we're assuming it would require a lot of work on all of your ends because I don't know, it's hard to imagine you've got a procedure for what happens if you're short paid $100 or $1,000 from the California ISO and how you track that, that there's that work on behalf of 50, 100, 200 market participants. I'm not sure how many get hit here. But so if we're wrong about that assumption, if that's, keep that in mind as we go through the next few proposals, because that's behind some of this. The idea that even if a default loss were small, the administrative cost of a default, there may be other costs too, but just the administrative costs are actually higher than the amount of the loss. And so that we ought to be doing things, adjusting the rules if necessary to try to avoid these small defaults if possible. That's the point. And this is the main reason behind this rule, behind the proposal to clarify the rule about replenishing the CAISO reserve account. Now, I'm putting the tariff language in this slide, and it's because somebody pointed out to me that it's not in the paper. I think every other time that the paper has a red line that'd be helpful, it's in the paper and you all can find it there. This one's described, so to be clear, that's the change. I'll stop so people can read it if they want to. But this is what we're talking about here. What the change would do is mean that the replenishment would happen only if the ISO determines that the default amount or any part cannot be recovered. Got a few more proposals about replenishment, and then we'll shift to questions there. There's also a clarification related to the penalty reserve account. Mentioned earlier, that's also available to cover defaults. The ISO would seek replenishment from the defaulting party if we can, but not from the market as a whole. That's the replenishment that doesn't apply to the penalty reserve account. There is again, it was something that happened in this 2011 tariff amendment, but there's a tariff subsection that could be misread to suggest that the market should replenish the penalty reserve account, and we want to delete that section. This section is copied in I think it's a long footnote in the middle of the paper, where you can find it if you want to track exactly what we're proposing. I think this is the last proposal about use of the reserve account. This is not, it's not happened yet, but when we have a market participant that's insolvent, but has not filed for bankruptcy, they tend to very rapidly accumulate these late payment and late posting penalties, because every week, maybe more often than that, we're asking them to post more collateral. They don't pay the market for several weeks in a row while their last few invoices come out. And so they get a large amount of penalties. And they, of course, because they're not paying, they don't pay those penalties either. Now, financially, the way this works, the summary of it is the penalty reserve ends up, in those cases, ends up paying their invoice, and then the money goes back into the penalty reserve. So this is a non-problem, or it's been a non-problem, as long as the penalties are on each invoice are lower than the amount in the penalty reserve. But it occurs to us that you know what? I'm realizing I'm on the wrong slide here, but let me finish describing it. It occurs to us that we want to take care of that problem. Actually, look, I got on a roll here, and I'm talking about something that's on the wrong slide. It's related. Hold the thought about the penalty reserve account. That has to do with separate invoicing, which is just coming up in a moment. Reserve accounts. The tariff right now uses mandatory language about the reserve accounts. It says if there's a default and we can't clear the market, the ISO shall take money from the reserve accounts. That makes sense. That's benefited the market, and it always makes sense if there are funds in the reserve accounts that are sufficient to clear the market, and that's how it's been over all the sort of defaults over the past 20 years. It occurs to us that this might not make sense. This mandatory use of the default, of the reserve accounts would not make sense necessarily if the default amount exceeds what we have in the reserve accounts combined. And I'll try to explain why, but the proposal, as detailed in the paper, is to give the ISO flexibility or discretion to determine in this situation only, when there's not enough, if there were a default and the amount of the default exceeds the combined balance of the reserve accounts, the ISO would make a judgment about what's in the best interest of the market, whether it's best to send out the money from the reserve accounts to reduce the total amount of the default and yet still have a default loss, or to do something else. Let me try to explain why it might make sense to hold off on this, on the use of the money. This is the next slide. Let's say we had a very large default, and at the moment, the reserve accounts have less than $1.9 million in them. So we reduce, the market as a whole would end up on that invoice with an additional combined $1.9 million, much smaller shares for each participant. But what you'd have there is the reserve account balances would be entirely depleted, and there'd be nothing to deal with the following weeks. And in my experience, if we, around these bankruptcies, if we were to have one that required losses, you would probably have a series of, you'd have 3-4 weeks in a row of defaults, and potentially more than that, depending on how the recalculation statements were going. And so this hasn't occurred. This is hypothetical, but what we're proposing is to give the ISO discretion, if we thought it made sense, to try to hold back on the reserve account, maybe leave the market to take a large initial hit, but then avoid the series of smaller defaults that might happen after that. And so sometimes when you propose a discretionary rule, you try to put out careful guidelines. That's not really possible here. I mean, we put out a standard in the paper about, and the idea is to try to do what benefits the market, reduces overall administrative costs. But these situations are complicated. They haven't happened before. I'm not exactly sure how to describe what this would involve, but we think having this discretion would be could be helpful to the market if we had what looked like a series of defaults coming. And remember, there's another scenario I should have mentioned in looking at this. One scenario we considered, in addition to those I mentioned, were what would happen if you had general financial stress, a 2008 kind of situation. where you had more than one market participant in financial trouble at the same time. That is at least a scenario where you could imagine seeing, where we could imagine anticipating a large default followed by small defaults, because you have different sizes of market participants. That's the kind of situation where this might be helpful. So let me stop there. Sorry for any confusion about me getting ahead of myself there. Are there any questions about these proposals? Right. Well, here,
No questions.
nothing. Yeah.
There are no questions on the line.
Okay. Thank you. And again, if questions occur to you later, my email's on the second to last slide. I'd be happy to talk through any of this with you, work through, try to figure out how this would work. Okay. New area of proposals. I mentioned the 2011 tariff amendment, where there's this step 2 to allocating default losses, where the losses, any losses, get spread to the entire market. We've got a proposal to sort of tweak that to avoid a situation or a possibility of allocating default losses to new participants. Here's what we mean. So under this is, if you're trying to follow along in the tariff, it's section 112917. It's a long section. This was the 2011 tariff amendment that was adopted through a settlement. And what it requires the ISO to do every quarter is to calculate default loss percentages for the market. In case there's a default loss, how much is allocated where. And the rule is, if we have a loss, the loss is allocated according to the percentages for the, quote, current calendar quarter. Now, that's fine, that's how it should be if there's a default on initial invoices. But when we were thinking through all of this, game planning it, it occurred to us that defaults can also occur on a later recalculation. So let's say on a T plus 21M recalculation statement or a T plus 24M. In other words, 2 years after the initial trade date, things get recalculated, and sometimes those recalculations can result in new charges that would be, in a case of a bankrupt market participant, pre-petition charges. And so you could have a new default 2 years after the fact. And in the meantime, new participants could have joined the market. Now, it's hard to imagine a scenario where this is a lot of money, but just the very idea that after a bankruptcy and after a period of financial distress, entities that joined after that might even have any fraction of a past financial trouble just seems like a bad idea. These could be situations where the market is trying to attract new suppliers. And so what we propose as a tweak to the tariff rules to avoid that possibility is to, instead of the current language, which uses percentages for the current calendar quarter, to instead use the percentages that were in effect at the time of the initial default or bankruptcy filing. We can, at this point, that's just a concept. We can iron out exactly the details when we get to the tariff language review process. But the idea then is that the current percentages at the time the trouble began, those are the people who would be allocated the loss, and we'd be able to attract new suppliers and assure them that they wouldn't be touched.
Yeah, instead of just sweeping it all into the current calendar quarter. Yeah.
Any questions or comments on that proposal? Right. Keep going. Related to these loss allocation percentages, this is a minor change, but new percentages are posted for each quarter. On April 1st, well, boy, there should have been new percentages a couple days ago. I feel like I saw that notice with October 1st, the first day of the quarter. They are calculated, the tariff says they're to be calculated using settlement and payment data from over the most recent 4 quarters where T+70B statements are available. The idea is to have high quality data. We'd like it to be both high quality and a little more current though, because what happened, there was a settlement timeline change recently that folks will remember that brought about the new timelines, and that was in 2021. And after that change, it became clear that the second settlement statement, the T+70B data, takes more than a quarter to get. In other words, it's not available within 90 days. And so what this means is that those 4 quarters are 1 more quarter out of date than they need to be. And so what we propose to do is, and there's red line tariff language in the paper, but is to use more recent data by using 3 quarters of data from the T+70B statements, that's higher quality, closer to final, and for the most recent available quarter, using data from T+9B statements. And once that quarter becomes a little bit older, as time passes, then T+70B data would be substituted in for that quarter. I hope that's, I mean, one more time to illustrate, so that would mean if you go with this proposal and it were in effect at the time on April 1st, 2024, the data that goes into these allocations would be the data from all of 2023. In other words, it's 90 days out of date. This would enable that slightly more current data to be used, and the last quarter, 4th quarter of 2023, would be T+9B data instead of T+70B data. So it'd be slightly more initial, tentative, subject to refinement, but more current. So, and thus more fair and accurate. Any questions on that proposal?
There are no questions in queue.
Thank you. Let's keep going. Rules about the distribution of funds collected from defaulting participants. There are 4 sections in 1129 that deal with what happens if there's a default loss and then the ISO collects, where does the money go? And if you look at these 4 sections, you could reconcile them, but they're sort of 4 different ways of looking at the elephant. They all look at different aspects of it. And so rather than to avoid a fight someday, we want to take all these rules and consolidate them and be clear what the priorities are if we were in this situation. So this is what they would, this is what they'd be. We'd reimburse losses caused by that debtor. In other words, if there's more than one default out there, and we collect from debtor A as opposed to debtor B, we're going to use those to pay the losses caused by debtor A's default. In this order, first, any GMC that was not collected. Now, and then the internal accounts. Internal accounts is like the CRR balancing account. Now, let me be clear. I'd be stunned if we were to ever get to that, because GMC and internal accounts have the first priority on every Tuesday as we collect money.
Yeah.
But this is just to align. The purpose of listing that first is to align the priority of payments on a Tuesday with the priority of payments for a later collection, just to avoid a dispute. Second one is to replenish the CAISO reserve account, the one that has to be replenished if it's funded defaults or funded to cash flow. Third is to market participants that may have been allocated part of the shortfall, and to do it beginning with the oldest unpaid invoice. Pay off the oldest unpaid invoice, get that paid in full, then go to the next. And that's the rule that's what's reflected, this oldest invoice first, that's what's in the tariff currently. It's just putting all these rules in the same place. To continue there, if after every market participant's paid, we've collected more, then we'd use that to replenish the penalty reserve that had been used. And then there's one more rule that's currently in section 112917. It's about if the ISO were to collect small amounts, less than $5,000, we'd have discretion to hold these and await further collections. That's this administrative cost issue that I mentioned before behind some of these. So that's it. I'm going to just, in case anybody wants to look. So that those would be the orders of payment if there's a default loss in the ISO, and the ISO would subsequently collect. Questions on that proposal?
No questions in queue.
Thank you. Okay. Now we're on what I jumped ahead to earlier. Sorry, this is about separate invoicing. Separate invoicing was developed back in 2001. I guess what happened was, I came to this after the fact, but there was it was one of the first times the ISO ever did a settlement recalculation, which is now just business as usual. Realized an initial settlement from December 2000 was incorrect, and then they reran it. Well, the problem was the biggest market participant in December 2000 was the power exchange, which ceased operating for crisis historians in January 2001. And the ISO, then the settlements team at the time, put the recalculation on the June and July of 2001 bills, and so those entities were due money from the PX. Well, for the most part, those people were due money from the PX anyway, but that affected a new participant. Somebody had joined the market in June of 2000 to help us operate more reliably that summer, and that was a very unfortunate thing to have happen, to have them shorted by the PX by an old participant. And so what was developed at the time was the idea of separate invoicing from the market. And the idea of separate invoicing is to isolate or to contain default losses where they belong. And those provisions are still in the tariff, and it says that things like old disputes and old settlement recalculations can be separately invoiced, with the idea that if there's a default loss, the folks who don't receive it are the entities who are due money on the old collection, but we don't spread that to new participants. The one proposal, this is something else that in that 2011 tariff amendment that was just maybe not aware of all the implications of what was being done, wrote some language that might be construed to undo separate invoicing, or at least in tension with the language about separate invoicing. And so one of our proposals is to clarify the authority to issue separate invoices so that they are not subject to reallocation to the entire market. And so I'll give you one example. It's coming up somewhere else, but folks may be familiar with Amendment 60 litigation. It was something that went on from like 2004 to 2019 or 20, and it had to do with a large number of payments from 2004 to 2009. And FERC finally finished, and it was done, and there was a reallocation, and Denise and her team collected all the money that was due. But if money hadn't been collected, the losses should go to the 2004 to 2009 market participants, not to today's market. Currently, Section 112917 could be misread, suggest that on that kind of situation there'd be a reallocation to today's market. We want to clarify that so that there can be separate invoicing. Now, two specific proposals related to separate invoicing. One of them is we want to be able to separately invoice late payments, these late payment or posting penalties. This is what I jumped the gun and, sorry, just misread a slide and started talking about this earlier. If you have a market participant that's insolvent and not bankrupt, their penalties can accrue quickly. We want the ability, if it were necessary to protect the market, to separately invoice these penalties. And this illustrates, okay, we'll get, this illustrates the use of separate invoicing. If we were to separately invoice late payment or posting penalties, and that market participant with the credit due to the penalty reserve account, and there's a default like we expect because they're accumulating late payment penalties, the shortfall goes entirely to the penalty reserve account and not to the market. We think that's a benefit that avoids an unnecessary, even however small, loss that would go to the market. And so that's the proposal. We'll get to Mr. Fager's therapy in a moment from the chat. Let me see if there's, are there any, I hope that wasn't too abstract, but let me keep going in the absence of a question. Another one that needs authority for separate invoicing are Black Start services. This is Black Start services as opposed to Black Start Energy. Black Start Energy is settled in the normal way through the market. But Black Start units that provide Black Start service have separate usually three-party agreements, but those agreements contemplate being bilateral. In other words, the payment for the Black Start services are due from the PTO, which charges them out through its reliability tariff. And the idea is that it's that PTO that's liable for the payments, and if there's a default, it's their responsibility. So our proposal would be to also add tariff authority to clarify that these Black Start services can be invoiced separately from the market. All right. Questions, comments, and I promise not to mention, no, I can't promise, amendments, there's another reference to Amendment 60. Sorry if that traumatized you. Any questions on separate invoicing?
No questions in queue.
Thank you. Okay. Here's the other amendments. We've got to just mention this. The proposal is to allow the ISO to write off a small amount of out-of-cycle invoices, up to $2,000, and cover it from the CAISO reserve account. And this is an efficiency, a good use of your resources proposal. So what happened in Amendment 60 is Denise, Dennis, Shauna, a whole range of folks, I'm sure I missed some important ones, managed to collect every cent that was due on invoices going back to participants from long ago. And it's great. It avoided any legal questions, which I appreciate. But it might not have been the very best use of time, or it might not be in the future if we have out-of-cycle invoices, because when participants are gone, collecting the last small amounts can be quite costly. And so this proposal would, if the ISO thought it would benefit the market, be more efficient overall, would allow the ISO to cover a small total amount from the CAISO reserve without replenishing the reserve, instead of trying to spend the time and effort to collect the last cent. We hope this doesn't, we don't believe this would be any disincentive to payment of people who have old invoices at $10. It's just better use of your GMC dollars. That's the proposal. I missed the question slide here. So are there any questions about that? Otherwise, we're moving on to a new group of proposals. All right. moving toward the end here. We're definitely in the tail part of this. Methods of electronic payment. I'm going to let, right now the tariff requires payment by Fedwire or ACH. That's too specific. There are other possibilities. I'm going to let Denise talk about them, but the tariff amendment would generalize that and say that payment can be made by any means provided in a business practice manual, and that would allow adjustments. Now, Denise, why might we want to adjust?
Yeah, so for those who don't know, the Federal Reserve recently introduced something called the FedNow service. And the FedNow service is essentially a way to make and receive payments instantaneously. They settle instantaneously. Some banks offer something similar to the FedNow service. It's called real-time payments. It's not exactly on the FedNow rail, but it's considered, kind of a real-time settlement service. This has been sort of rolled out by the Fed to actually expedite payments around the world, really. So anyway, it was rolled out in July, this last July. And so what the ISO wants to do is to give market participants, a little bit more flexibility and allow this FedNow service, real-time payments, any sort of electronic payment, which would be described, of course, in the BPM as we update it. And so really that's the proposal. Many people are feeling like real-time payments is really a good thing to have. The ISO will probably be doing some analysis to see which customers and vendors would actually like the services. And once we get that, get that data pulled together, we will probably roll it out. But we want to make sure that we have the BPM sort of updated to enable any type of electronic payment going forward. Just a general. Any questions on that proposal or any?
And again,
thoughts?
the proposal is to simply change the tariff to remove the requirement of Fedwire or ACH and defer the issue to a business practice manual.
Yeah, just to provide more flexibility.
There are no questions on the line.
Thank you. We've got a few tariff cleanup items. One of these is a rule about payment imbalances. It's not going to unpack the rest of these, but this one's worth highlighting. All settlement statements, because of the neutrality charge or credit, net to zero. And cash flow would too, except that about, 15, 20 years ago, small invoices were eliminated. The history of this is detailed in the paper, but basically it cost, at the time, it cost more in funds to send or receive invoices less than $10. And so the tariff, what we even do now is we zero out invoices or payment advices of less than $10. The practice is, and I believe this is authorized by the tariff, is that the ISO reserve account is used to cover the shortfall and is also receives any excess payment that's excess because of these small imbalances. As explained in the paper, the purpose is to expressly reflect this practice, that these small imbalances would go into and come out of the ISO reserve account. Here are the other tariff cleanup proposals. They're described well in the paper, and I'm happy to answer any questions about them. But there's a definition of settlement statement. It's actually not in the appendix. It's in 1129.732, and in the timeline amendment that became effective in 2021 of the new settlement timeline, this update seemed to have gotten missed. There's also one about there are two different tariff sections that address the quote basis for billing and payment. We're trying to combine what's there into one of those sections and delete the other so there aren't two sections regulating one topic. There's a bigger one here, but you'll see it in the tariff language review process. But there's some terminology issues throughout Section 1111 and 1129. The way I think of it is there's a difference between settlement on the one hand and billing and payment. Settlement, in other words, getting charges or credits for, say, providing energy or ancillary services, that's an accounting function. As opposed to billing and payment, which we've been talking about today, what happens on Wednesdays and the following Tuesday, that's a cash flow. That's about payment. And these terms get confused in the tariff. And, you know, sometimes it'll say, somebody probably says something like this, exactly, a resource that supplies ancillary services will be paid, and it'll describe the rate. But they're not paid. They're going to get settlement credits. And why does this matter? Well, the only time it matters, FERC's never going to be confused. None of you all are confused. But if you had an aggressive bankruptcy law firm like we did once 20 years ago, they can take tariff language that they can argue is unambiguous to a bankruptcy judge, and the bankruptcy judge can interpret that. And FERC sometimes will take the position that it has a lot of authority in these cases, but it's not winning those cases. And in its fights with bankruptcy courts. And so to avoid any risk that this could all be misunderstood in the wrong place, we're going to propose changes to use settlement terms, accounting terms, when we're talking about the settlement process on settlement statements, and payment terms when we're talking about payment on billing and payment to reduce the risk there. That's what that's about. Last of the tariff cleanup items has to do with some extraneous language from, this must go back 13 years, but there's language in the section of 1114 about neutrality that talked about settlement on a monthly basis, and we haven't settled on a monthly basis for 15 years, so we caught that one. I'm happy to talk about any of these cleanup, but those are don't reflect, not even arguably reflect policy changes. Do we have any questions on that?
There are no questions in queue.
That's the end of the draft final proposal. This last item is the issue paper, where we sort of have requests to all of you. We're looking for ideas, proposals, and here's what it is. We came to appreciate with the 2021 bankruptcy that load-serving utilities within and other load-serving entities within the ISO balancing authority pose a distinct risk in terms of this credit management situation. And it has to do with this. The ability for all other transactions, everything but load, a central piece of the risk management that benefits all of you is the ability to terminate transactions. We can tell somebody, you know, starting tomorrow, so I don't know what time of the day, but essentially about one day ahead, we can stop all transactions. So whoever poses a risk, the risk ends. That is different for load. Load is uniquely difficult to terminate for reasons you all can imagine, but it has to do with the fact that the retail customers need to be transferred to a creditworthy entity, and that takes time. We avoided any problem in the May, June 2021 bankruptcy situation, but advance notice sure would have helped. What happened there was it was called Western Community Energy. It was a relatively new CCA. It had financial problems for 2 or 3 financial quarters, and if we'd known about it, we could have worked with them much sooner than we did, and this would have made the situation easier. And so what we're looking at is we're focused on, really on entities that are represented by scheduling coordinators, because we've got a direct line of sight on scheduling coordinators who have to either post collateral or apply for credit. We get information about them. But really, the issue are entities that we don't interact with, but are part of the larger financial network. And we have no information about the financial condition of some of these entities. And we're sensitive to the burden of gathering information and so we want to, if possible, we want to seek to tap into some existing mechanism. But here's what we think would help. If we could get at least the same information that we get from about publicly traded entities or entities that have credit rating, which is kind of an overall financial report, at least quarterly, plus some way of getting notice about material changes. So, like I said, it's similar to what the information that's available about those kind of entities. A helpful, something to look at, there's section 12.115, which applies to entities that have a little bit of unsecured credit with the ISO, is they have to report material adverse events. We're not necessarily looking to put people under that, but that's kind of a disclosure obligation we're looking for if important things happen. I mean, we didn't find out about this bankruptcy until a little bit after it happened. And it was something that was, very important to us because this was an entity that sort of load on the ISO grid. And so this is an issue paper, and this is really a question, and we'll put this out for written comments, or if people want to talk about it now or throw something out now, would be great. But is there a way the ISO can get this information without putting an unnecessary burden on you? Is there some kind of existing disclosure mechanism we could tap into? Or do we need to look for something else? What's the easiest way to get this done? And that's the end. That's what we have. If there are comments, it'd be great. Otherwise, we'll wrap this up and tell you how to reach us if you have questions.
We have a hand from Seth.
Yeah, please unmute, Seth.
Yeah, thank you, Seth, with DC Energy. So I'm looking at that material adverse clause change, and I'm wondering, are the LSCs the only ones that are not required to notify the CAISO of a material adverse change to their credit quality?
There's a couple of things there. The material adverse change clause applies to any entity that has unsecured credit. And so I don't know, I have the advantage of actually not knowing who's got unsecured credit, but any entity that has unsecured credit with us is subject to 12.115. Does that help?
Yeah, I would just strongly...
Sorry, Seth, go ahead.
I would strongly encourage you to change that. Every entity in the CAISO should have that obligation to report material adverse change. I don't really understand why. That's kind of ubiquitous across all RTOs and ISOs, as I understand it, and actually gets back to some of the CA exemptions back in like 2014, I think.
Okay. Well, by all means, put that in your comments and explain. If you think we ought to take this or do something that's broader, please explain that.
I mean, at the end of the day, it's the market participants that are backstopping all this. So, yeah, I think that's just important to have in there. Yeah, I'll consider including that in comments. Thank you.
Okay. Yep. Thank you. Appreciate that. Thank you. Any other comments? Anything else right now?
No additional questions. Thank you.
All right. There's time to change your mind on that if anybody thinks of anything. But otherwise, what what we're asking for are written comments by the end of the day, October 17th, using a template that will be available later today or possibly early tomorrow on the initiative webpage. We'll put that out there. This is what I promised. These things are, sounds like these aren't causing people concern, but if you have questions about them, or if other folks, if you have questions that come up while you're writing comments, or if other folks at your organization have questions, don't hesitate to email me. It'd be a little much to say I like to talk about this stuff, but you can tell I'm maybe more enthusiastic about it than I should be. Here's where we are. So again, for all the proposed changes except for this visibility into load, this is a draft final proposal. So we anticipate bringing this to the board, these proposals to the board, the governing body, for decision in November. We expect, as explained in the paper, that these would all be subject to joint authority that has to be approved by both, because all these rules apply to EIM entities, participants, et cetera. For the issue paper, we will resume, and anything else that if folks have other ideas that we ought to consider, anything that might get bumped back, we'll resume in January, we think. Certainly in early 2024. That's it. That's my last slide.
Otherwise, I guess, Dan, we should just make one point as a reminder. The intention is to bring the first half of the slide deck, so everything except the load-serving entity suggestions that you might have, is to bring that to the board in December.
November,
excuse me. So if you have anything in the meantime about anything, let us know right away if you can.
Hearing nothing, I think we're all done here, unless people thought of late questions. Really appreciate your attention and your questions, and like I said, don't hesitate to reach out. I think we're done, Elena.
All right, we can conclude this conference. Thank you, everybody.
That concludes the conference. You may now disconnect.